Everyone is looking at the price of PYTH right now and seeing a disaster. They see a token down 95% from the highs, trading around 5 cents, and they assume the project is dead. But when I look at the on-chain data, I see something completely different. I see a protocol that just hit $1 million in annualized recurring revenue. I see a buyback mechanism that quietly started purchasing tokens off the open market in January. And most importantly, on the weekly chart, I see a specific technical signal that has only happened 2 other times in this token's history. Both of those times, the price rallied over 150%. But here's the catch. There's a massive supply shock coming soon in May that nobody is talking about. Today, we are going to look at the raw data, the exact technical invalidation level, and the strategy I'm using to trade this setup without getting wrecked. Welcome back to Crypto Yield Pro. Let's be honest about the market sentiment right now. It is brutal. If you are holding PYTH, you have been in pain for months. We are sitting between 5 and 6 cents, essentially hovering at the all-time low support zone. The retail crowd has completely capitulated. You can see it in the active address count, which has dropped from 10,000 monthly users down to just 3,300. The tourists have left the building. Usually, this is exactly where I get interested. When the timeline goes quiet and the moon boys stop posting rocket emojis, that is often where the real asymmetry is found. But we cannot just blindly buy the dip because it is cheap. Something trading at 5 cents can easily go to 0. We need to know if the engine is still running under the hood. So before we open the charts, we need to look at the fundamentals. Is this a zombie oracle, or is it mispriced infrastructure? Let's look at the hard numbers, because there is a huge misconception right now. When you open DeFi Llama, the first thing you see is a chart that looks like a disaster, collapsing from over $1.4 billion down to 80 million. But do not let that fool you. That chart is just the staking value, which dropped mainly because the token price dropped. It is a reflection of sentiment, not utility. The metric that actually matters for an oracle is total value secured, or TVS. And right now, that number is sitting at a massive $3.6 billion. That is billions of dollars of economic value trusting PYTH data feeds every single second. The protocol is working. Now, look at the revenue. In the fourth quarter of 2025, PYTH Pro hit a major milestone. They surpassed $1 million in annualized recurring revenue. They have 54 active institutional subscribers, which is up almost 93% quarter over quarter. Why does this matter? Because it proves they are pivoting successfully. They are not just a crypto oracle anymore. They are becoming the data layer for real-world assets. The report shows that equities and forex feeds now make up almost 70% of their oracle composition. They are feeding stock prices on-chain. That is a tangible product-market fit. But the most bullish catalyst is the PYTH Reserve. As of January 5th, the protocol started using 33% of its revenue to buy back PYTH tokens on the open market. They bought over 2 million tokens in the first month alone. This transforms the token from a useless governance coin into a value-accruing asset. However, I have to be the bearer of bad news too. We have to talk about the supply schedule. In May, just a few months from now, there is a massive unlock event. We are talking about 37% of the floating supply hitting the market at once. That is over $120 million worth of selling pressure. This puts us in a very specific scenario. We have improving fundamentals and a buyback mechanism fighting against a looming supply shock. This means we have a window of opportunity, but we cannot marry this bag forever. Now, let's move to the weekly chart, because this is where the trade setup becomes clear. If you look at the price action since early 2024, we have been trapped in this massive descending channel, marked by the orange dotted lines. It has been a slow, painful bleed. But zoom in closer to what has happened since the local top in August 2025. We have formed a second structure inside that channel, a falling wedge marked by the white dotted trend line. This is a classic compression pattern. Price is currently being squeezed between the all-time low support at 3 cents and this descending resistance line.
Right now, PYTH is fighting for its life against 3 major resistance levels. First, we have the descending trend line itself. Second, we have the 10 and 21 weekly exponential moving averages. Those are the blue lines on my chart. And third, we have the 236 Fibonacci level at 6 cents. We are literally right underneath this cluster of resistance. Also, the price has been rejected by the 55 exponential moving average, the purple line, twice in the last 2 years. Until we reclaim these exponential moving averages, mainly the 21, the trend remains technically bearish. However, look at the indicator below the price action. This is the Heikin-Ashi Relative Strength Index. It's currently oversold, but it is pointing up. More importantly, it's printing a massive bullish divergence. The price made a lower low, but the momentum indicator made a higher low. This is the third time in history we have seen this signal. The last 2 times this happened, PYTH rallied 150% and 200% respectively. If history rhymes, a move from the bottom here would take us exactly to the 10 to 12 cent region. That lines up perfectly with 618 Fibonacci retracement level and the top of the descending channel. So, how am I playing this? I'm treating this as a high-risk, high-reward recovery play. I allocate about 1% of my total portfolio to this, split between a long-term hold and a short-term trade. My accumulation zone, the load zone, is strictly between 4 and 6 cents. We are in that box right now. But as a sophisticated investor, I care more about where I'm wrong than where I'm right. My invalidation level is a weekly close below 3.3 cents. Why 3 cents? Because that is a clear breakdown of the market structure. If we close a weekly candle below that red dashed line, the falling wedge probably has failed, the support is gone, and price discovery to the downside begins. I'll not hold a short-term bag through that. I'll cut the loss and move on. Now for the upside. I'm not aiming for the moon here, I'm aiming for liquidity. My first take profit target is 10 cents. That is the psychological resistance. My second target is 12 cents. This is the golden pocket, the 618 fib, and the top of the channel. If we get there, I am selling a significant portion of my short-term position. I'll essentially be de-risking the trade entirely. If, and only if, the market goes parabolic, I have moonbag targets at 25 cents and 80 cents. But given the supply shock coming in May 2026, I plan to be heavily trimmed out of this position before that unlock hits. I traded this token in 2025 and did well, but I got stopped out during the October 10th flush. That is part of the game. I kept my profits, reduced my average cost on the long-term bag, and now I feel safe re-entering the PYTH arena. To summarize my thesis, the fundamentals are improving with real institutional revenue and buybacks, but the technicals are at a make or break point with a massive supply overhang looming in May. This is not a set-it-and-forget-it investment. This is a tactical trade. We buy the fear at support, we respect the invalidation at 3 cents, and we sell into the strength at 12 cents. If you want to see exactly when I'm entering and exiting these trades in real time, or if you want to see how I manage the rest of my portfolio, make sure to join my free Telegram group. The link is in the pinned comment below. And if you are sitting on stablecoins waiting for this dip to play out, you need to be earning yield on them while you wait. I just released a step-by-step guide on how to earn over 20% APY on your stables using liquidity pools. You should watch that video next. None of this is financial advice. I'm just a guy looking at charts. Stay safe, manage your risk, and I'll see you in the next one.